Hey guys, Anthony Curran here. Once again, we're talking about different topics involving money. This video is going to be the basics of the stock market. So the first thing people always ask is, what is the stock market? Well, the stock market is a place where you can go to buy shares of a company. Shares of a company are small, tiny pieces of ownership. Back in the old days, you used to get a physical paper certificate that was an actual paper stock. With the technological age we're living in now, they've kind of done away with that, and everything's pretty much all online now. But basically, you would go to a service, E-Trade, Charles Schwab, there's a number of them, and you create an account with them. You link it to a bank account or a credit card or a debit card, whatever you decide to do. And then from there, you can select different companies that are public and buy different shares of them. So people ask me, what's the point in buying a stock? What does that do for me? Well, the way that the stock market works, you might have heard this before, you buy low, sell high. So people who are more aggressive in their trading than I am, they're going to find a company that they think is trading, meaning the price of the stock is less than what it should normally be. And there's a lot of different ways to do it. Basically what they'll do is they'll buy stock when it's cheaper than they think it's going to be, and they'll wait for it to build up in value. When it builds to a higher point in value, then they sell the stock. So if you bought a stock at $20 and you sold it at $30, hypothetically, you make that $10 difference between where you bought it and where you sold it. And when you map that out across thousands and thousands of transactions, you find a lot of people make a living doing just that. So a lot of people would say, well, if I'm going to keep riding a stock until it makes more money, why don't I just hold the stock indefinitely and keep making money? So you can do that. There's a lot of people that do. That's long-term investing. You hold the stock because you think it'll continue to build value over time. And that's more the category that I play in. But on the opposite side of that, if you bought a stock at, say, $20, and then it drops down to $10, you may want to sell it and cut your losses on the off chance that it drops down to $0 and you lose all of your money. There's certainly people who have lost millions and millions of dollars, if not all of their money, on the stock market. So you've got to remember, this is basically a sophisticated form of gambling. Any money that you put into the stock market, you need to be able to survive without that money. This should only be money that you use in addition to your already budgeted money in order to live. This should be additional income that you're using to grow and to build. So a lot of people say, well, I found a company that I want to buy stock in, but I can't find it on the stock exchange. Well, it's very possible you might be looking at what's called a private company. Private companies are owned by private citizens, whereas public companies are owned by the public, meaning that we trade it on the stock market and anybody can buy shares, sell shares, whatever they want to do. The benefit to being a private company is that you don't have to answer to stockholders. So if you're somebody who's running a company that's considering going public, obviously you already know the main attraction with going public is when you give out your initial purchase offering or IPO, your company stands to make a lot of money initially. Basically, the IPO is the way that the company gives out shares. Once they've been traded on that primary market, meaning they get traded the first time, sold out by the company to the stock exchange, they now go to the stock exchange, which is called a secondary market. And that's where they're traded for the rest of time. They're bought and sold on that stock exchange in the secondary market. So the company won't necessarily make money on their stocks anymore. The only way they'll make money is by buying the stock and helping it to rise, or buying other stocks, that sort of thing. So an easy way to make money is through a process called diversification. For those of you who don't know what diversification is, it's taking stocks from a variety of different markets or industries and putting them together into your portfolio. Your portfolio is the collection of stocks that you own. So let's say I bought shares in ExxonMobil, which is a gas company. They're obviously in the gas industry. I can also buy shares in Apple, which is in the technology industry. That way, if, say, the price of gas goes way, way down and the price of oil goes down, this company's going to lose value. But maybe in that same week, the price of electronics goes up, which means that the value of Apple goes up because they can sell their product for more money. You see, by putting eggs in different baskets, you protect yourself from one industry suddenly tanking. And of course, the more diversified your portfolio is, the safer it is. Now, the downside to having an overly diversified portfolio is that you may not make as much money as somebody with less diversification. So, if you put all your eggs in one basket and that company suddenly takes off, you're going to make a lot more money than that other guy who's being more careful and putting things all over the place. But you're also riding that risk of, well, if that company tanks, you go down with the ship. So it's really a question of how much security do you want, as opposed to how much profit potential do you want. So if you've heard of stocks, you may have also heard of mutual funds. So mutual funds are basically corporations or groups where the public gives them money to invest, and then a professional management team manages their investments. It's great if you want to take a lot of the guesswork out, especially if you're a beginner and you want to make an initial investment, but you don't really know how to get started. The limitation is you're not in control of what you buy and sell. So they do the research, they work full time at finding the right investments for you, but the limitation is you don't get to pick what gets bought and sold. The nice thing with going through a mutual fund, oftentimes you can buy and sell that fund's shares daily, just like you would a stock, which means if you don't like the way that they're controlling the money, you may be able to sell your shares and get out and do your own thing. One of the biggest names in investing is Warren Buffett, who's also called the Oracle of Omaha or the Sage of Omaha, what have you. He got his start using a system called value investing, which I'll cover in a different video. And over time, he's built up his fortune. He started out with next to nothing and now is one of the top 10 wealthiest people in the world with a fortune valued over 50 billion with a B dollars. So it's possible, if you get started early and do the research and really work on it, that you could someday build your value in the stock market to the point that you were making billions of dollars. But it's very, very risky, and it's not guaranteed at all. It's also very difficult, and just like anything else, it takes plenty of time. So I hope that that answered all the questions you might have about the basics of how the stock market works. If you have any questions, please comment in the comment section below. You can also send me an email at anthonytcurran@gmail.com. And of course, please like and subscribe so that we can build up a viewership. Thanks so much, guys, and I hope to see you at the next video.